Hi, and welcome to this episode of Your Future, Your Finances. I'm your host, Brian Kuhn. Here we interview a variety of experts on the topics of personal finance, personal growth, and current events here in Maryland, D.C., and nationally. In this first segment, we have the opportunity to check in on Wall Street and the economy. We will discuss the stock and bond markets, tariffs, taxes, and more. My guest today is Mr. John Giordani, CFA, and Chief Investment Officer of Planning Solutions Group based in Maple Lawn, Maryland. Welcome to the show.
Thanks, Brian.
Let's start with an update on today's markets. What's working and what isn't?
Thanks, Brian. I think as we make our way through the fourth quarter, investors are really caught in a game of tug of war between fear and greed. On the positive side, you have corporate earnings really growing nicely. You also have a fundamental backdrop of economic growth approaching 4%. But then on the negative side, you have fears of rising interest rates. You have China trade tariffs popping up in the headlines. And all of this has left investors feeling a little bit confused about where to go. On the asset side, it's really been a one-trick pony. U.S. stocks are driving the markets this year. International stocks are down year to date, and bonds, which is very rare, are also down year to date. It would only be the fourth time in 40 years that the bond market actually put in negative returns. So overall, diversified investors, they're feeling pretty gloomy as we head toward the end of the year.
Starting in 2018, the beginning of this year, we had some major tax legislation. How has that changed things?
Yeah, it's been a nice stimulative effect. I mean, let's think about it. It passed before the legislation was enacted. U.S. corporate tax rate was approximately 35%, near the top in the developed world. Now, I like to be number one, but maybe not so much in tax rates. So bottom line, when this legislation was enacted, you had hundreds of billions of dollars dropping right to the profits of U.S. corporations. And so profits have surged. And not only that, but it spurred investments in new projects, hiring, pay raises, and for shareholders, you're looking at increased dividends, increased corporate buybacks, and near record high stock prices, all because of this. The other impact is just on confidence. People are feeling a lot more optimistic because they see more money when they open up their wallet, and that cannot be understated. Small business optimism remains near record highs, and I think this legislation overall was much needed to put us on equal footing with some of our trading partners across the world.
Now, in the news for consumers, they're probably reading news about the China and tariffs. What do you think people should understand about that?
So, Brian, this is one of the main themes on the what could go wrong story, and it is a big issue as we approach year end and even into the beginning of next year. The Trump administration is playing hardball as we look across the globe, and so far that was really successful with Mexico and Canada. I don't think that may be the case with China, and I think that's why international markets especially and U.S. stocks have recently sold off here. So far, the Trump administration and the tit for tat with China is costing about $120 billion. That's the amount of tariffs. And when I say the amount of tariffs, I mean that's a tax. Tariffs are not good. They are a tax. Prices rise, consumers pull back on spending, economic growth slows, and when that happens, people lose jobs and confidence worsens. And I think you're starting to see those effects make their way into the prices of asset classes. So you have to ask yourself, well, why did we enact tariffs? And most of it's probably political, but when you really deep dive into the numbers, you do see that there are some potentially real issues between trade between the U.S. and other countries. Take China, for instance. When we export a good and sell a good in their country, they tax us close to 12 to 13% just to sell that good. The U.S., on the other hand, when China sells a good here, on average, the tariff is close to 4%. So you have to ask yourself, is that really fair? But more importantly, I think when it comes to China, is the administration saying, look, U.S. companies are tired of being ripped off. The IP study from 2017, I think it was the 2017 IP Commission report, came up with the conclusions that Chinese theft of either trade or goods amounts to $600 to $700 billion per year. So that's a real significant impact. The Trump administration is arguing for China to open up their markets and put us really on a level playing field and allow our companies to do more business in China fair and equally.
So are there specific things that people would be on the lookout for that will become more expensive?
Yeah, I think that's a great question as well. Inflation is a tale of, I'd say it's a tale of two cities. Things we need versus things we want. Our needs, food, healthcare, college costs, those things are escalating way above the natural inflation rate. But then on the other hand, things we want, technology especially, those things get cheaper over time. Now the things we need, that's really squeezing the middle class and has been a political hot button as well, and for very good reason. On the things we want side, everything, maybe not iPhones are getting more or cheaper, but pretty much everything else does. I know my one neighbor likes to buy the hot gadget of the year and brag to us about how much it costs, and I always joke and text him pictures when I go out and find that same thing a year later 50 or 60% cheaper. And so you think about that, flat screen televisions, entertainment, etc. Over time, those goods usually get cheaper. And I think that what we have right here in our pockets, our cell phones, is really going to keep inflation at bay as well, because think about, you can, with a click of a couple buttons, compare prices across the globe. And we've seen that have a tremendous impact already. Companies that have not been able to adapt to these pricing challenges have been left by the wayside and been replaced by lower cost places like Amazon.
Speaking of China and the rest of the world, I've heard you speak about this growing middle class, the rest of the world, and its potential effect on the global economy.
Yeah, I mean, this is just an incredible growth story and is a tremendous tailwind as we look out the next decade. The rise of the emerging markets middle class should last until at least 2030. And I'm talking about places like Southeast Asia, India, etc. Brookings Institute just did a comprehensive study looking at this, and some of their conclusions are just point to how attractive it is to look outside the United States for opportunities. Their conclusion is by 2030, global middle class consumption could be $29 more trillion than it is in 2015. And hard to believe that only about $1 trillion of that will come from developed economies, those being US, Europe, and Japan. Most of that spending, 28 trillion of it, will come from places like Southeast Asia and India, et cetera. So for investors, the opportunity set is just too large to ignore. Now, emerging markets and investing there is very volatile and not for the weak of heart. So you definitely want to make sure you talk to a financial professional or an expert in that area before you allocate any of your investments to this asset class.
So speaking of volatility and investing, for someone who's watching who's just getting started with investing, what do you think are some tips for them?
Oh, great question. Yes, starting early I think is the most important item I can emphasize. Time is your best friend. If you wait even 10 years to start saving, you have to save multiples more to wind up at the same end point. Compound interest, as Einstein called it, it's the eighth wonder of the world. So don't worry about trying to time the markets and finding the hot investment. Systematically save, invest in a well-diversified portfolio, and really try and keep your emotions out of your investment decisions. If you can't or don't have an iron stomach, then find an investment professional to work with. And most importantly, don't take hot tips from friends. Other one is live beneath your means. I've never met the Joneses, but trying to keep up with them sounds like a recipe for disaster. And lastly, educate me. It amazes me how many people spend more time planning a vacation than they do thinking about their retirement.
Lastly, is a question I always like to ask the guests, for someone not getting started with investing, but considering a career path,
right,
possibly investment research following the markets. From your experience, what would be some advice for them?
Yeah, going back to an early comment, educate yourself. Read, and did I mention read some more? That's the most important thing, I think, is to really get an in-depth knowledge of this business. There's so many wonderful books and resources out there, especially with the rise of the internet and technology, and I'd start with people like Warren Buffett, Seth Klarman, Howard Marks, to name a few. And you really have to have a passion for this business. to make it go long-term, a long-term run at it. You don't have to major in finance, but take some introductory classes in finance to see if it may be a good fit, or in other areas, economics, or just general markets. And internships, they didn't exist 25 years ago when I got in this field, but now everybody wants an intern. So I think that's a great opportunity, so take advantage of it. I mean, what better way to figure out if it's a career for you than working in it for 3 or 4 months. Also, reach out to someone. People are helpers. If you reach out to an expert or somebody who's got more credentials, they're going to they love to help you in normal. And just in our area here, there's a CFA society, and I know something close and dear to your heart, the FPA society as well.
Absolutely. We'll appreciate the time and information today. Where can folks find you online?
psgplanning.com.
Okay, great.
Thanks, Brian.
All right. We were speaking with John Giordani of Planning Solutions Group. Thank you very much. We'll be right back.
You're still watching? Okay, good. Because I'm about to tell you why the message you see on the screen might someday become a reality unless we do something to prevent it. First, let's talk about net neutrality. What is it? Net neutrality is the principle that internet service providers, companies like Comcast, Verizon, and T-Mobile, can't favor or block certain websites regardless of the source. This means that when you access the internet, you have access to the whole internet in all its weird and wonderful glory, from giants like Google to that new business's very first website. Right now, we do have a free and open internet, but that might change. Legislation is currently being introduced that will allow larger companies to pay ISPs to receive preferential treatment. The newly appointed FCC chairman, Ajit Pai, this guy right here, has been quoted as saying he wanted to take a weed whacker to current FCC rules and that net neutrality's, quote, days are numbered. That sounds pretty concerning if you ask me. So why should you care? Well, firstly, net neutrality makes it possible for small business owners and entrepreneurs to launch their business online, create effective advertising, and reach customers. Without net neutrality, the next Amazon or Netflix might never see the light of day. Secondly, the open internet allows minority communities to have a voice, to share their stories, and connect with like-minded individuals. Current net neutrality rules allow people of color and members of the LGBT community to speak freely online without fear of gatekeeping or misrepresentation. So you might be thinking, what happens next? Maybe you don't think net neutrality is all that important. Maybe you'd like some more information. If that's the case, I encourage you to do some research of your own. I hear the internet is a great place to start.
Hi, and welcome back to Your Future, Your Finances. In today's strong economy, employers are looking for ways to differentiate themselves and attract talent. One of the ways they are doing that is with a term called financial wellness. To discuss this topic, we have a guest with us, Mr. Mark Brogley, Director of Business Development at Planning Solutions Group in Maple Lawn, Maryland. Thanks for joining us.
Thanks, Brian.
So, why is wellness an important topic with human resource management these days?
Well, first off, wellness overall is a term used in both physical health and in mental health, and everyone wants to feel healthy and be healthy. But basically with the HR teams today, they are challenged with finding the benefits that are going to support their employees, the most comprehensive benefits at the best value.
Yep. So what are companies trying to do to retain talent and find talent?
Well, basically it's have the right benefits packages that will provide the support to those employees, and they're basically looking to enhance the packages in a way that will retain those employees that are long-term with the firm, and also differentiate the firm when they're out in the marketplace trying to hire. So it's both a differentiation and hopefully increasing their competitiveness when they have a nice human resource packages, benefits.
So how is a good financial wellness program tied into a company's overall health or other benefits?
Yeah, great question, Brian. It's tied in because it is actually a bottom line financial issue. When an employee or an executive is having financial stress at home, they're not focused at work. So they're bringing that stress into the workplace. And basically that's adding to other issues within the firm of absenteeism and major lost productivity across all the different segments of the business. So an employer can actually offer financial wellness will help in this way.
Do you have any statistics that relate to that topic?
I do. In one of the recent surveys that PricewaterhouseCoopers did earlier this year in 2018, it basically related what the employees were looking for in packages and their employers did not currently offer. So the most desired benefits were basically when a professional had basically validation of an employee's decisions that they made for their financial situation. Another 25% that they wanted to have a comprehensive financial wellness program offered by unbiased professionals. And at 20%, they wanted basically help in understanding what all the different parts of the employee benefit package were.
What's the difference between financial planning and a financial wellness program?
A great question, Brian. Financial wellness as an overall program is the education that starts out giving those general topics to the employees, whether it's at the executive level, mid-management, or at the staff level. So those topics then will lead to providing the individuals one-on-one support for their individual needs. So in today's environment, the retirement planning and financial planning is not a do-it-yourself effort. You need to have a qualified professional that has access to industry solutions and put together by an experienced team. In addition, on an individual basis, we get down to what those needs are because everybody's case is absolutely unique. Another part of financial wellness education is on a macro scale is that we provide all of these various topics first and then allow the employees to come in and seek that individual use. So what's important, I believe, and what we have is an ability to survey the employees first and understand what their greatest needs are.
Can you give some examples of employee surveying and why that's important and how it works?
Sure. So just as I mentioned, we actually conduct surveys, and it's best if a program offers surveys of these financial topics and related subjects to an executive level, to a mid-management level, and to a staff level, because in where they are in life and in their progress in their financial world, their life and their financial well-being, their financial situation, if you will, they have the different needs of what those topics are. So we survey them first in order to understand the priority, and that helps develop a program over a 24 to 36 month program of what their needs are. We serve up those first.
What other components or issues should HR teams be looking for when they're evaluating financial wellness?
Sure. So basically, employers sometimes feel like they already are getting a financial wellness program from their retirement plan or 401k provider, when in actuality that's really only looking at a small segment or a piece of the puzzle, if you will, of someone's holistic financial picture. So basically, a good program should provide the entire spectrum of financial topics that relate to a person, not just what's involved in the investment portfolio. So this is what we mean by holistic financial education and cross-disciplinary subjects being covered within a financial wellness program.
Any other examples or best practices that come to mind?
Sure. Well, as I mentioned earlier, when these topics and when the discussions are fresh in employees' minds, it's always best to very shortly afterwards offer one-on-one sessions. So, and especially if these programs are offered on the campus or at the firm, it makes it convenient for employees. So those one-on-one sessions might be, as an example, maybe half-hour sessions where employees can sign up, come into a conference room and sit down and have an open discussion with a financial professional. And it's not a full financial planning, paid engagement or anything, but it's a get-to-know-you session. And it's also a way that they can get more specific questions answered. So that's a great best practice to have immediately after the session, so that it's covering those questions that are maybe coming back from the spouse or significant other after they went home and talked about the financial education. A second piece to this also is offering to the employees online education throughout the year. It doesn't have to be just at a quarterly meeting or whatnot. So if they do have an immediate need or they have questions, have access to who those professionals are so they can reach out and get their questions answered.
Yeah. What types of reporting are employers asking for?
Right. So as I mentioned earlier, the surveys are important, and so if you roll up the surveys to the the head of HR or the executive team through the HR program, they can see those educational subjects and the desire. Another part of the reporting that they're asking for is usability. So in some cases, programs are put in place but then never used. And that's really, it's a shame, because this type of education can really help families and help, basically down range. So the surveying, not only up front, but during the program, to see who's signing up for the seminars, how many attendees, and then of those that attended, what's their feedback. So we really advocate for having good evaluation forms after each one of those sessions.
Yeah.
And continue that throughout the 24 to 36 month engagement, so that the executive team can see the trends of more employees using this, and therefore helping increase the focus at work when folks are getting their questions answered and not distracted by their financial crises or just their financial worries at home.
Yeah. Anything else we haven't yet covered?
Well, let's see. So as you can tell, I'm passionate about this. We've done this in a number of different organizations, some larger organizations and small organizations, and the impact downrange is very evident, and we've heard good reports of that. My wife happens to be in HR, and so I know how HR teams are stressed a lot with limited resources. So it's the joke in HR a lot of times is that they're underpaid and overworked, and that is true in many, many cases. So if a program can be well-rounded, it can be comprehensive in nature, and be offered to the HR team to implement, and make it an easy to implement comprehensive program, I really believe that then it will be utilized by the firm and utilized by those families downrange.
Yeah, absolutely. Well, thank you very much for the information and appearing. How can folks find you online?
You can reach me by my email address, as always the best. It's mbroglie@psgplanning.com, and I believe you're going to be providing that on screen. But Brian, it was a wonderful just having this discussion. I look forward to future discussions about these types of topics.
Thanks very much.
Thank you.
All right. We've run out of time for this segment. We thank you for watching Your Future, Your Finances, and hope you have some takeaways. I'm your host, Brian Kuhn. And if you have any questions for the show or one of the guests, you may contact me at bkuhn@psgclarity.com. Lastly, as always, a thank you to Laurel TV for their production and airing of this segment. You can watch the show every Sunday at 10 a.m. on Comcast Channel 71 and 996 for HD, and Verizon Channel 12, or on the live stream at laureltv.org, or on the YouTube channel, which you can subscribe to if you'd like. See you next time.